We had a few opportunities to sell via secondary, which we mostly passed on, and those were actually quite bad decisions for us.
So we took half our chips off the table, we left the other half in.
We are pushing heavily for liquidity opportunities.
Secondary has become a much more readily used tool.
So I'm J.S. Conway from Real Ventures, one of the co-founders of the firm, a pre-seed fund. Been doing it since 2008. And in the fall, I've been asked to take on the role of generating liquidity across our funds, which is something that really was an afterthought for us. Like we, as a pre-seed investors, when we started in the business, you come in and then you come out when the founders sell the business or when there's an IPO. Although I think Shopify has gone public as a startup since then, but there hasn't been that many of those. And we had a few opportunities to sell via secondary, which we mostly passed on. And those were actually quite bad decisions for us because of that mindset of sticking it through with the founders. So since the fall, we've shifted that perspective to become much more intentional in how we look at a secondary opportunity. And really the mindset is every moment that we stay in an asset, we're making an investment decision to stay in that asset. And when that, that asset is worth half the fund, I mean, that's a lot of money to commit.
Hi, everybody. I'm Neha Kara. I'm a managing partner at a fund called IRV. It is investing in early stage deep tech companies or hard tech or frontier tech, however you want to define that. Prior to that, I've been in venture capital for about 13 years. Prior to that, I was with a firm in New York called 2048 Ventures. And then prior to that, in the relevant fund that we're talking about today, I had co-founded a fund called 500 Startups Canada, which is now in its 9th year. And we are pushing heavily, like JS said, for liquidity opportunities.
Devin Galloway, one of the partners at Garage Capital. We're based in Waterloo, seed, pre-seed stage fund as well. And then I also am a founder myself too in a scale-up stage company called Vidyard.
Good morning, I'm Ian Carew. I'm a managing director at Northleaf Capital. We're a $30 billion AUM alternative asset management firm across venture capital, private equity, infrastructure, and private credit. I help lead the venture capital and growth equity strategy across a Canadian-focused venture and growth fund of funds and a secondary-focused growth equity fund. And we've been active users of the secondary market, both generating liquidity for investors as well as acquiring positions in both funds and directs as new investments.
Great. So just wanted to highlight the fact here that these are all our partners and that we've done secondaries, in different ways. And today, maybe we can highlight a bit some of the transactions we've done, and where we're providing liquidity in the ecosystem. So maybe I'll just start with you, JS. And
yeah.
I asked him an open question. He told me this morning, he said, that's dangerous. Do not ask me open questions. And so I said, okay, but it's because when we talked earlier this week, and I thought it was really thoughtful because I said, it's interesting that Real has dedicated a resource, if you will, that you like. And that's part of the problem I see in funds, which is not, is it an afterthought, right? So I'm curious, can you tell me a bit of the journey, how that happened at Real and sort of what the discipline, how that evolved into the discipline it is today?
Yeah. Well, like I mentioned earlier, it started with making bad decisions. So we had the opportunity to get out or sell portions of some of our assets through rounds of funding, and choose not to because the founders weren't selling a significant portion. And our thesis was we sort of align ourselves with the founders. And those companies have since, some of them have cratered to almost zero, or they were recap rounds. And being an early investor, and no dry powder to reinvest, we lost significant value in those assets. And so that brought this notion of, well, maybe we have to be more objective. Like the same way we do so much work coming into an asset, we do all this due diligence on the people, on the company, on the markets. Maybe we need to keep doing that for over the life of the company to determine whether we should be holding this asset or whether we should be trying to sell it. And because you guys, the True North Fund, like you have a very tight box. You come in late, and you have a tight box, and that box is, I would qualify it for me when I look at it, that's your definition of a sustainable company. But as a pre-seed investor, like a really small portion of our companies fit that box, but there's a lot of value in those assets, maybe for other players, but it's not unclear whether all these companies will be sustainable. It doesn't mean we can't get a lot of value from them. Right. And that's sort of where this decision was made to start doing it. Now, the other was that we didn't have a lot of DPI across our funds, and there's a portion of the team that wanted to raise another fund, and there was some feedback from the LPs. Yes, you got a lot of TVPI, but you need to crystallize that. You've been at it for long enough, and it did happen. Like we did, I guess the moment you start spending time on something, it starts generating results, and it has for us in the last 12 months.
Yeah. Interesting. Hey, just so people know, we did a transaction with JS on Clutch, which you heard today. You saw the numbers. Yeah. We love it. And I was laughing because I sent JS an email a couple of weeks ago, and I said, "Hey, really like Clutch. Interested in selling more?" And I got like an email back, "No." Okay, there's sort of no gray there.
Yeah, I mean, the thing with Clutch, and I think this goes back to, like, I was more, when I started this, I was an entrepreneur when I started Real Ventures, and I was just thinking about the upside and not the fund management business. And the Clutch transaction is a great example of that. Like, we didn't want to sell Clutch, but we were in year 8 of the fund, and we were hitting the limit of our recycling. So, and we didn't have enough reserves, we felt, to support the rest of the portfolio. So we decided to sell a small portion of our Clutch position so that we could protect against the downside in some of the other assets that we had. Not a decision that I would have made, 4 years ago.
So it's kind of a thoughtful evolution as the branch.
Yeah, it's like we're fund managers. We need to, it's not just about making the most amount of money on every single investment that we make. We just have to be objective and look at the business.
So it's interesting, right? Because you don't know what asset to sell or when. So maybe I'll put you on the spot then. And we were chatting, you told a funny story, the wrong twice. And I really thought it was interesting because as a GP, you do struggle with, which assets do I sell? Is this the right time? Am I leaving money on the table? So maybe you can share your experience, because I think that's something everybody struggles with.
Yeah, it's tough. And you got to kind of, you can't have much of an ego in the secondary world. So we had a company, it was a real high flyer, but similar to JS, started thinking about managing the asset or the portfolio as a whole. We had a secondary offer in front of us on that company. And so we thought about it as a team and a partnership quite a bit, and ended up deciding to sell a significant portion of our position, about half of our position. And there's a bunch of fellow investors who said, you guys are crazy. Like, this company's been a total rocket ship. And it was a total rocket ship. And, both, it was a fund management decision of, we want to start showing some DPI, company's done great. But also we were asking ourselves some tough questions about the company around moat and around kind of like long-term, how do we become a multi-billion dollar company that the valuation at that time implied we needed to become. And so we took half our chips off the table. We left the other half in. And then a couple months later, we were proven wrong. And someone came along and had a big step up in the valuation for the company. And we went back to our thinking and said, we still feel the same way. Like, it's now, the valuation's quadrupled, but we're still questioning the moat. And it also felt like a kind of a product of the zero interest rate environment. And so we sold half again. And then after that, things really did not go in that company's favor, and it went downhill from there. But we should have sold none the first time and all of it the second time, and we actually sold half both times. And so optimal strategy, we would have done none and then all. But ultimately, we kind of it's hard to have that conviction to do it all. There's other smart people on the other side of the table that are buying, but at the same time, felt both for our portfolio and for our thesis on the company, it felt right to trim the position. But as I said, you can't have a strong ego on it, because you're going to be, especially if you're selling half, you're inevitably wrong on half of the choice. So
that change your sort of lens now when you look at it. Maybe you adopt more of a systematic approach, as in sort of don't try and pick the winners you want to hold back, versus maybe you sort of do it systematically over time, or just curious.
Yeah, I really like how JS described it. Like we've got a number of assets that we've held for quite some time, and we'll continue to hold because we're really bullish on, I still think they're in the early innings. And so it's not a programmatic, okay, we're going to sell at this moment. And we've talked about that, should we sell when we're a certain multiple on our initial investment or something like that? But it really is in each company, where's the state of the business? Do we strongly believe in the moat? So like JS said, these private markets are often somewhat illiquid, but when you have that decision to sell or not to sell, or frankly, you could be buying too. We now have an opportunities fund that we can be buying too. You have to sit down and think that through and make a decision amongst a partnership. And but one of your options is often to sell. So we evaluate that.
Well, now the new problem you have is you're potentially buying and selling, or selling and buying with the two different strategies. And how do you navigate that?
Yeah, we haven't done that yet, but I'm imagining that like there will be a case where the early stage fund is ready to wind up that position, but the opportunities fund wants to be making next stage investments. So I'm imagining we'll cross that bridge where one will be selling, the other will be buying.
So Ian, curious, just because on any given day you're wearing three hats, right? You could be investing in a fund, you could be doing a direct investment. We're looking at one together, or looking at specific assets. So on the fund side, when you sit down with GPs like Devin, and I guess you're in a tough position, right? You don't want to be prescriptive and tell them what they should do. So I'm just curious, what's that interaction like, and sort of, how far as an LP in that scenario will you go with the GPs?
Yeah, I think at the end of the day, we don't want to step into the shoes of the GPs, but I think, like, you hear a lot of it's already come out through GS and Devin around, these aren't isolated conversations around a direct secondary. You need to think about it in the context of your overall funds and other requirements, what it allows you to do, kind of move the chess pieces around a little bit. And while we do have some GPs that, hey, we're going to hold everything to the ultimate exit, and that's one strategy. Others may be more programmatic. We get to a 3x, we're going to take our cost off. There's kind of any range in the middle. I think GPs should have a framework around, here's how we're going to discuss these opportunities, here's how we're going to think about them, here's how we're going to process them. To your first example, you could have sold it, got it wrong, and then that just drove every single following decision, right? We're just going to hold. But I think being conscious that it's not a singular decision, or it's not, you need to make the same decision every time, but have an appropriate framework to have those conversations. And I'd say the one big change that's happened probably over the last 7-10 years is, to your comment, JS, back in the day, you could not sell a position in your company, right? Your syndicate partners would be like, you're a bad partner. The entrepreneur would be, hey, you're not entrepreneur friendly, and you kind of get blacklisted. I'd say today, secondaries become a much more readily used tool, both to get access to companies and to manage your return. And I think that just opens up kind of the aperture in terms of what GPs can do, or entrepreneurs can do, to manage kind of liquidity in their situations.
And I think it's important to, like, on your point, Ian, talk about what's happened in venture over the last, since 2017, because SoftBank Vision One Fund, which everyone knows SoftBank, they didn't get going right until 2017, and it was still very early days for them. Up until then, I remember, and I'm sure you guys do too, I had a website bookmarked on my browser, and it listed the top private billion-dollar companies in the world, and there was 100. And you'd go through that list and say, oh, are there any Canadian companies on here? That list is now well north of 1,000 over a 7 to 8 year period, which tells you all of these companies are staying private longer because of the mega funds like SoftBank, Coatue, Tiger that came in. When we were setting up our funds, you weren't thinking about an exit opportunity in a secondary. You were thinking what JS described: buy, hold until exit, which usually happens 7 to 10 years, and then, rinse and repeat. And now when you're thinking about your funds, every single transaction that comes together, it's, am I buying, am I holding, or am I selling? So that whole narrative is completely changed, and it's kind of flipped venture completely on its head.
Why don't we talk about, in that vein, the transaction you and I did together, because I think that's a really interesting case where for your fund and the age of the fund, it made sense to do a secondary transaction. So
Yeah, that was in Hume. So Hume came about, they were getting acquired in a mostly all share transaction, a little bit of cash. And our fund was sitting in year 8. This is 500 Canada. And to us, the way we think about it is really through a couple of things. One is the growth. So what kind of growth are we going to be getting on this holding? And could that be better served by giving liquidity back to the LPs to then go generate that same growth, if not more? And then second to that is really around what's our position on this cap table. So in Hume's case, it was, I think, a common shareholding in a company we knew nothing about at a point when our fund was sitting at year 8. And so for us, it was a bit of a no-brainer to say, if we can get cash back and return it to LPs, then, we can sort of pass the puck over to you to manage this.
that was great. And to be honest, I brought it to the partnership and I was like, okay, spoke with Neha at 500. They have this opportunity. It might be in an M&A mix. And I put it out there and I said, might be a long shot. And Chris goes, I know the CEO of that Australian company. Let's lean in. And it took us like 72 hours.
Yeah.
And we got it done. And we thought that was like a great example of, hey, solving a problem for someone in the ecosystem, providing the liquidity they needed, right? So I think that worked well.
Miss Tyler would do the same thing, or he would do.
One of us will be right, one of us will be wrong.
And feel free to jump in if anyone has questions, because we have a lot of entrepreneurs in the room. But Ian made an interesting point, right? Which is, and I've seen this, where secondaries, Chris and I are champions. We see the benefit for the ecosystem, for the shareholders, the employees, and everyone there. But at the same time, I think Ian, you said, we can be viewed as not entrepreneur friendly because you're stepping back. And so when I speak with JS, I asked him that question, like, how did you manage this across your portfolio? Because Real has 4 or 5. And I said, is this difficult? So maybe just talk, if you could talk a bit about that.
Well, the approach we adopted is to be very transparent with everyone. So first talk with the CEO, founder, the board, and just share the perspective, like why we're here. And I think that helps a lot. And then, there's a dialogue that gets initiated. And and also do the same with the LPs. Not all of the LPs, but one of our funds that's been the most active over the past year is our 2014 fund. So, it's 11 years, and we have a few LPs in that fund that are large LPs, and to just before selling an asset, to have the conversation with them just to get their perspective. Of course, they're not going to tell you what to do, but through the dialogue, there's a common understanding develops. And I just like to have as many perspectives as I can from all the stakeholders before making that kind of decision.
Yeah, makes sense. Pick on the two of you. So you recently did a transaction together for a different reason, or similar, I guess. But
Very similar.
Tell a bit about that, because I thought it was really interesting. And then maybe I'd ask Ian if you could follow up and maybe explain from your lens why that transaction made sense, because Northleaf's a big machine, and this wasn't necessarily something I would have thought you would be in your stack bracket.
Yeah, sure. So very similar to JS's story in that we have our 2015 fund, or I guess it was very end of 2014. So we were in our first extension of preconceived two extensions. We were in year 11, and we love the portfolio. There's a great portfolio of companies sitting there that we wanted to continue to go long in. But at the same time, we were in year 11. And, the initial promise was a 10-year fund with the potential 2 extensions to maybe go to 12 years. But we felt we owed LPs the option, right? It was, fortunately, the fund had returned. The LPs had almost 2 times their money back in DPI. But if they were ready to wind things up, and it was a small fund, it was a $6 million fund. So if, and I remember having some conversations with some of these LPs, and it's like, I've got a kitchen reno underway, and I'd really love to get that last chunk out of the fund, and I could not have to cash in something else. So it was really the transaction. We basically went to the LP base and said, we're really bullish about the portfolio. We want to go long in the companies here, but we owe you the option. And thankfully, with Ian and Northleaf being supportive, we were able to give them the option of you could take door number one and sell today and realize another chunk on your initial investment, or you could go along with us and see if we could turn this into a 10x fund. And it was great because it gave the portfolio or the LP base optionality. Many stayed in. Many chose to take the door offered by Northleaf, and people do it for all kinds of underlying reasons, right? Just like we all, as VCs, have portfolio math that we're doing. We had two LPs who had written $500K checks out of multi-$100 million funds, and they were just trying to wind up too. And getting this from a 3x to a 10x fund would be great, but it was kind of a rounding error for them either way, and they were ready to wind it up. It was kind of an administrative burden. So it's just, I think our job is to make these markets or give these folks some liquidity options along the way. And so just like we have to make a decision, we let them make the decision. And fortunately, Ian was able to support us making that option available.
Yeah, and I think from our perspective, we're big fans of Garage. We've been long-term supporters since their Fund 3. We shared their excitement around their Fund 2 portfolio. And from our perspective, stepping into year 11, the losers are washed out. Someone's paid the fees and expenses to get to that point, and we can underwrite kind of an existing portfolio. That's different than a primary fund commitment that we would make. We are taking the risk that we believe they got to hit a 10x fund in order to generate attractive returns. So it's not like these are riskless transactions for us. We obviously price it at we call it an aggressively fair discount. Again, we don't want to be so aggressive that people won't transact with us going forward, or we kind of ruin our reputation in the market. But obviously, we want to extract a good level of discount to help make our numbers work. Well, I mean, the average discount for a fund position in the U.S. was 25% last year, right? So, and if you factor in maturity of the GP, scale of the portfolio, all these kind of things can lead to some pretty attractive, again, time will tell whether it's an attractive discount or fairly priced. And we like these small transactions. There's not a lot of competition. A lot of our peers will drop out because they're too small. Our first purchase with version 1, we're big fans of Boris and Angela at version 1. Big supporters in their Fund 2 onward. We didn't have exposure to Fund 1. Our first check there was $400K, first purchase $400K, and now we bought up 40% of the fund. So you just keep chipping away at these things that you like, and the risk profile changes. And again, I think you had a singular seller. We priced it, and then you took it to all the LPs and offered it up and stacked. And it's a bit of a pain for Alicia to kind of try and close, 10, 12 LPs at a single shot. But again, it aggregates to something that's interesting. And if we replicate that over several managers, it builds out to a nice part of our portfolio.
Getting the 4-minute hook here. Maybe I'll put this one to you, Neha, because we have, several entrepreneurs in the room, and, we see it on secondaries, but, one of the challenges I think you've bumped up against, you and I talked about it, though, is around, information rights and the ability to protect that, right? And losing sometimes, often as, JS early stage funds, you lose those major investor rights. So just curious your experience on that. And, is there something we can be doing better, as an ecosystem to make sure that that sort of doesn't gum up the machine?
Yeah, we've had a lot of challenge with trying to, even if we come to a company with a potential buyer for our holdings, we've run up into challenges. I've now run up into it 3 times where the company does not want to supply certain information to make that buyer comfortable in acquiring our ownership. And it puts everybody in a tricky situation, right? As a fund, again, you're dealing with markets where liquidity is not happening for extended periods of time. If you don't get that cash out, you can't redeploy into new companies. For the founders of those companies, they're saying, what I've heard from them is, we don't want there to be a secondary transaction price because that may affect, or that may create tension for a future price we want to set on the share if we do choose to go public. And for the secondary buyer, they're saying, I just need to see some comprehensive financial statements before I can seal the deal. So unless you find buyers like, Chris happened to know the founder of this company that was being acquired by Humi and made a few phone calls. I mean, that's rare. But if you want to be doing secondaries in sort of a more common fashion, then this tension needs to ease up somehow. And I don't know what the answer is.
Yeah, and I think talking, or JS, we talked about ROFRs and same thing, information rights. And I like your words, but you basically said, as that happens and the late stage investor comes in, we tend to give up those rights, and you're really relying on the management team and CEO to protect you.
Well, when you say we, it's really, I mean, from my perspective, it's really the founders who decide, because I think those terms are important for late stage investors, but they're not deal breakers. And very often I've seen the founders keep their own ROFR and types of rights, but the major investor rights, below like a 5 or 3% ownership stake, may go away, and that creates a more difficult. It's harder then to sell, because I would say in one of our two largest transactions this year, while I did work with the company and to do the sale, I had major investor rights. I was able to sell without their support, but I didn't have to tell all of the other investors that I was doing the deal, and as a result, I got to do the whole thing myself. And I learned afterwards that two other early stage investors would have liked to participate in the transaction had they known. And I think if I look at those experiences in all of the transactions we've done thus far, and I include yours as well, working collaboratively with the CEO, founder, enabled them to influence who the potential acquirers were. And in all cases, they were interested in having these people be either new investors or the bigger investors on the cap table, with an alignment that made more sense, like very long-term investors. And so I think there is value in the founder management engaging with early stage investors to collaborate on finding a way to enable that transition from investors that really are not supportive anymore, not because they don't want to be. All of the founders I've ever invested in can always call me and I'll help them, but I can't help them financially anymore with someone who has a very long-term view. It can be aligned, for the next 10, 15, 20 years.
I just wanted to highlight that because it is so important for the industry. We want everyone to win and have liquidity, but obviously that is pretty significant, right? And so I think just to be mindful of it, and when that late stage investor comes in, if you don't have to give up those rights for your prior investors, it's worth fighting that battle. So I'll stop there. I don't know if there's questions. I'm getting the hook from Nick. If there's questions from the audience, but we really wanted to highlight, how we work with all of our partners, and secondaries and liquidity, takes many different forms, whether it's talking directly with funds such as yourself, right? Whether it's working with Ian on direct investments or larger proposals, or going in directly to companies and putting a program in place to make sure that employees and all shareholders get liquidity. So it's sort of multifaceted. And I would say since Chris and I started this, we've really expanded the aperture of the lens on that to really be more encompassing. So just wanted to highlight that.
Maybe, Sean, I'll just add one thing. Just part of the reason we're excited, maybe a bit of a plug for True North and Northleaf, is to Neha's point, you've got great access to data. We're in all the best GPs. We've got, 900 companies in our portfolio. We can get underneath the covers of these investments without having to take management time, which I think changes that equation, gives us a competitive advantage in those situations.
Awesome. Well, thank you everyone for your time. Appreciate it. Yeah.